It's a good question. So, being proactive and respectful with communication whenever they have some issues with their units.
So hello and welcome to PMML's podcast. Here I'm with Yacine Bouda, my associate and commercial real estate broker at PMML, and myself, Azamat Kar, senior vice president and commercial real estate broker as well. So Yacine, today the goal of our podcast is to have a better understanding on what's going on in the market, in the multifamily market, to be more precise, in Quebec in 2025. We're trying to help investors and real estate owners to understand what's going on. And I'm very curious to hear what you think the market will be in the next year as well. So we're trying to see what's going on and to have a sneak peek in the future and see what's going to be happening in the future as well. So I'm going to start by presenting a little bit PMML after we present ourselves. So PMML, we do real estate brokerage, we do mortgage brokerage for commercial properties, and we also have an insurance brokerage department. Our goal is to help our client creating value in the transactions from A to Z and help them to go through any kind of transaction in commercial real estate. So to start on today's market, I would like to know how would you describe the Quebec multifamily market in 2025?
First of all, I would say that I'm very thrilled that we're talking about this subject. Today, I believe it will have a lot of value for our clients because we're getting those type of questions. How's the market today? All the time. And there's no better person than us who been transacting for the last years, still in transactions currently, and we have other transactions that are still coming. So we really are the best people to know what's the current situation. So for your question about the current multifamily market, well, definitely has been a shift over the last few years. Post-pandemic market has been with very high interest in the beginning, very slow market in terms of buyers. They're not moving forward to do some acquisitions, but now once we're about 2-3 years later, we have different metrics in the market now. The interest rates have been going down. You have all the new laws that came into place in terms of tariffs from our neighbors from the south, which has been affecting the market as well. We're definitely seeing a lot of buyers going back into the market. They're aggressive. They're looking to buy a lot of properties. Even some buyers who are not necessarily from Montreal or from Quebec, people who used to invest mainly outside the province in Toronto, Ontario, Vancouver, and other cities of Canada. But I think it's the first year that the massive shift is.
Yeah, that's very interesting. You mentioned that because I was at the Canadian Apartment Conference in Toronto, and all the big REITs started all of a sudden talk about the Quebec market and the Montreal market as well. We see the interest from the rest of Canada, which is not doing so well, in my opinion, real estate wise, and Montreal that is still considered affordable for the rest of Canada and even from abroad. I never had so many international clients, either from Europe, from Middle East, or even the States that are focusing their investments in Canada. Right now, we see the Canadian dollar losing its power against the biggest currencies in the world, like the US dollar. So I have clients who are selling properties in the States for US money, they're transferring their funds in Canada, getting Canadian dollars. They're making 40% on their dollar to purchase properties here because they know that it's probably going to be a short midterm thing that's happening right now with the Canadian dollar, and in the near future it's probably going to regain its value. So there's an opportunity here just by making this shift in terms of buying with American dollars properties in Quebec for Canadian dollars and holding them for a couple of years. When the situation will stabilize for the Canadian economy, they will be doing a profit just on the exchange rate, not even talking about the value that the property is going to take over time. So that's very interesting that you mentioned that.
I want to ask you a question about what would you think is the main changes in the behavior of the investors currently in this current market, post-pandemic and everything?
Yeah, so if we post aside the international investors or the bigger buyers, the REITs, and we talk about the local investors and family offices or private investors in Quebec, we definitely see a shift where more and more of bigger family offices or even nonprofit organizations are looking for more stabilized properties. Right. And for newer constructions as well, because in their pipeline they have a lot of older properties that require investment and capex. So they're trying to balance their portfolios with newer assets, more stabilized assets as well, and especially in a time that we live right now where there is certain instability with the rental market. They're looking for something that's already been stabilized and not looking to do value add project necessarily on a big scale, because you never know. It's hard to predict the rental market for the next few months. We know that there was an immigration, the immigration was reduced drastically.
Down, definitely, yeah.
Yeah, it was a drastic slowdown. It was almost like a hard stop, basically. And we've seen that in the past few months, had a major impact on the rental market. We're discussing with many investors and owners, and we see that it's a little bit harder now with the rental.
Instead of taking like 2-3 days to rent your unit, now we're seeing 1 to 3 months maybe to rent a unit.
Yeah, it also will depend on the type of asset, right? If you have a unit that's $2,000 and over, that's going to take a little bit more time probably to rent. You have less rental, less pool of potential renters for that kind of unit. But even we see that now in the lower markets, in the units for thousands to $1,500 units are getting a little bit slower. I mean, for sure, for me it's like going back to normal, because the vacancy rate is about 4%, which is normal. We had a great rental market for owners, but it wasn't necessarily good for the tenants, because we had a housing crisis, right?
Yeah.
The vacancy rates were almost close to none. Like it was 0 point something in many regions in Quebec.
It's more like of a correction.
Exactly. It's more of a stabilization, I would say.
Right.
It's normal to have a unit vacant for a month or two between two tenants. It was normal. And we've seen a period where there was lineups of 50 people for one unit.
Everybody got used to it, yeah.
Yeah, and everybody got used to it. And now, out of the sudden, everybody's panicking because they think like, oh, it takes more time to rent. Oh, I've tried to increase by $500 my rent, and I don't get as many calls as I used to.
There used to be lineups, right?
Yeah, exactly. No more lineups, but it's back to normal, like the normal process of renting, which is not necessarily bad for the rest of the market, but that's a huge impact from immigration that we see, right? So if we go back to the question you asked me regarding the investors' behavior,
the change
I think we have to, the investors have to make this shift in the mindset and understanding that it is normal. It's not something to panic about. it's something that's normal, and the value that your property will take in time, it has to be an organic growth in value. Will stabilize into something normal. We've seen drastic changes in values between the beginning of the pandemic, where interest rates dropped close to 1%, and we had, the prices been skyrocketing since then, right? Now, and then after that, we saw interest rates coming up. Prices didn't really come down. They kept growing, and we couldn't continue like that forever. We need a stabilization, which we are in a stabilization right now. And the good news is that we've seen the federal budget, and in their program, the immigration will start again in the next few years. So the good news, the opportunity right now, it's basically whoever wants to buy a property now, thinking that it's going to be harder to rent. Well, the good news is that in the next few years, immigration will start again, and your vacancy rates will be close to none again, because whenever immigration starts, we don't build as much units as we need of them, because immigration is greater, right?
We have to remember that we're still in a housing crisis. And there still needs to be
I always call it affordable housing crisis.
Affordable housing crisis.
Because we do have a lot of newer constructions that are not affordable to many, and the vacancy rates in the new builds in the central areas are a little bit higher, which is normal because the price point is not affordable, so less people can afford it. But in everything else, if we do an average between affordable units and non-affordable units, well, the affordable units, the vacancy is close to none again. So if you have an existing property and your rents are averaging $1,500, you shouldn't be worried about your vacancy, even with what's going on now with the immigration. But again, the good news is that it will restart, because we see in the budget they will reopen the borders in order to bring back immigration. Hopefully they just gonna do it in a way that's be a little bit more controlled, and some qualified immigration process would be indeed needed, and we'll have vacancy rates close to 1% again. So that's where you could do your value add in the properties.
And I just want to go back a bit on that, because I totally agree about the point where you said that it's really a affordable housing crisis. With my many discussions with different property owners, I've been hearing the same. The issue right now with leasing the units is mainly related to those units that are going to be at a price point that goes above $1,500 per month. Whenever you're still under that, $1,400 for, let's say, a 3.5 or 4.5, depending where it is, you're still seeing those units get leased in under a month and a few days, a few weeks. But really, once we go above that for the bigger 4.5, the 5.5s, and that goes above the price point of $1,500, this is where we're going to see the owners, the landlords struggling a bit for leasing it. But it's just taking more time.
It's like a threshold mark close to $1,500. I would say it's close to the average of the provincial average rental, but it's also, if we look again, the vacancy rates is purely statistically, we see that everything that's below 1,500, it's still the vacancy rates are much lower, and normally everything that's above 1,500 and especially above $2,000 per month, vacancy rates are a little bit higher, which is a normal thing in today's market, especially where you cannot really rent a new build in downtown Montreal for cheaper, even if you wanted to, because it's going to be you'll be cash flow negative, and you'll be shooting yourself in the leg, because the construction costs, the land costs, the development costs are through the roof today. So it's not because the landlord or the owner of the property is greedy and wants the big buck for the property. Sometimes it's just to break even. You have to put certain prices that on the market are not affordable for many people. But in today's market, that's the break-even point, I would say. I know personally investors who are putting break-even points in their rentals, just because they don't necessarily even looking to be cash flow positive. They just want the property to be paying for itself. Because again, construction costs, development costs, land costs, and time frame, right? To develop a project in Montreal, it takes years of work, and materials. Construction materials are through the roof as well, very expensive. So a lot of people I see online in social medias are like, oh, the owner is greedy. He wants somebody left and he wants to increase it by $500. I'm like, yeah, but have you seen his increase in insurance payments? Have you seen his increases in tax payments? Have you seen his insurance, his increases in maintenance, right? Maintenance, you used to buy a 2x4 for $2. Now you have the same 2x4, you buy it for $8. You know, at some point, being an owner and an investor it's like a full-time job. You know, you want to make a certain profit, but it's not because they're greedy that we see that. It's because in today's market,
their own expenses are going up.
Exactly.
Well,
so
like
it's just to counterbalance.
Else.
Where is he going to go get that money? It's from the tenants. That's the only way, because that's the only income of the property. There's no other incomes that the property generates but from the tenants. So every additional cost that will be on the property will have to be delegated to the tenants in order to be able to survive, and for the property to be able to survive.
Nobody's gonna be a property owner if they have to be cash flow negative every month.
No, exactly.
For a big amount, they're able to sustain it for a bit, because there's other perks of owning properties, but it's not sustainable at all. And you need to if you want to have a real estate park that keeps being updated, renovated in a good condition, they need to make sure that they're having the cash flow enough to do those renovations, and that some of the tenants are gonna absorb those renovations as well. Definitely, they're the main one. They're the main people using it. So
and in the 2025 market, if we look until September 30th, starting October 1st, 2024 until September 30th, 2025, in Quebec only, in the province of Quebec, we had almost $7 billion in multifamily transactions in total. Okay, so that's a huge market in transaction that runs the economy. Besides every owner paying taxes, and whenever they sell, there is capital gain taxes, and we have a lot of ways to be taxed. Let's be honest. So that for the economy of the province, it's a very important sector, the real estate sector. So in order to have a healthy economy in the province, we have to focus on what are the drivers of our economy, right? On the microeconomy, real estate is one of the most important. We have to focus and see what are the solutions we can bring. Because to give you an example, as I said, there was almost $7 billion transacted in the multifamily market in Quebec. Which is 20%, almost 20%. It's like 19.3, I think, percent higher than it was to be previously. So why the difference in 2025 is because interest rates came down. You remember in 2024, interest rates were a little bit higher, and now interest rates in 2025, beginning 2025, were stabilized lower than they used to be, and people went back on the market. In 2023, 2024, we had less transactions, less volume. So what happened is that people accumulated some capital, They didn't want to buy because it was uncertain, interest rates were high, nobody really knew what to do. So a lot of my clients were in status quo. And they accumulated because they still had to refinance, they still had positive cash flow on their properties. So there was an accumulation of capital on the market. And in 2025, when interest rates were decreasing, well, everybody went on the market at the same time.
It started as soon as of, I think, the second week of January.
Yeah,
We're
exactly.
seeing
Everything was
the
selling.
Spike, properties that did not have any activity for a few months. You'd see randomly, you'd have bidding wars on it. I remember, I think I sold a few properties that had the exact scenarios. You know, I want to go further on that point about the interest rates because I want to see your, I want to see your opinion about, do you think that today the interest rate is the main factor that's going to make or break a deal in terms of if it's a good transaction or not?
It's a very good question. I think it's not the only thing. It's definitely a very important thing because the interest rates will basically give you more, lower interest rates will give you more purchase power, right? The lower the interest rate.
Let's discuss on how it really impacts a transaction. You know, we heard it all the time, maybe for the more beginner investors, we're aware of it, but how does the interest rate really affect a transaction in a good or bad way?
Okay, so the lower your interest rate is, the more you can afford to finance a property, right? So the lower your interest rate, the lower your cash down, which the cash down coming from your pocket. So that's a very simple rule, which is which has to be described in such a way. You have a property that is for sale for $1 million. In 2024, nobody can afford it because you need $400,000 down payment for it because interest rates are high. You need 40% down payment. You would get financing at 60% on the market value because we always getting finance on the economical value in commercial, right? So if we take the same ratios and we apply them on the market value, it's about 60-40 in 2024. Now in 2025, with lower interest rates and what we have today, I would say the same property sitting on the market for $1 million, same revenue, same expenses, nothing has changed in that perspective. The only thing that changed is the interest rate. And now, out of the sudden, you would need $250,000 to buy it instead of $400,000. So now
it's going to make a big difference.
100%, because now your ratio of down payment is 25% on the market value. We're not even talking about economical value. On the economical value, it's probably going to be 15%, depending the difference of the economical value and the market value, but that's another story. But now you have somebody who has $250,000 can afford $1 million property. Last year, with the same $250,000, he couldn't afford it because the down payment was $400,000. And again, nothing has changed in the property. Not the revenues, not the expenses. The only thing has changed is the interest rate. So the buying power I was talking about is the interest rate is very important in that perspective, right? So that's one story of what is important to consider in the price point of a property. It's definitely the interest rates because of the buying power, but there's also other ratios that are very important in my opinion. The price per unit. I don't know if a lot of people are using it. I know for instance, like in Europe, a lot of people like to use price per square foot even.
Even for residential, because we're using it as well, but mainly for retail properties, industrial properties.
Exactly.
They're using it for multi-res.
We use it a little bit less here, price per square foot, a little bit more in the newer constructions because we relatively relativize with the price per square foot to build. Right? So we can also see how much it's going to be costing to rent a square foot, an average. But in existing properties, financing is quite different in Quebec and in Canada. We get different programs, so we really look at the potential of financing, right? So cap rate becomes an important ratio, which is the net income divided by the price, right? So you get your cap
As a rate, yeah.
Yeah, as a rate and in percentage. So you have a good idea. In today's market, we're averaging 4.5 cap rate across the province. Certain region is going to be higher, certain areas will be lower. You know where is the lowest cap rate selling in Quebec right now?
No, tell me.
It's in Laval.
Wow.
Laval and North Shore of Montreal.
Doesn't surprise me really, honestly.
Yeah, lower than 4. It's actually at 3.992% average cap rate in the transactions. It's definitely a hub right now. It's developing a lot. The demographics are growing, especially during the pandemic. You remember that we had a lot of people leaving from Montreal to live further and especially in bigger.
Yeah, there's been a lot of new constructions. There's been cranes everywhere.
Exactly.
You know what? I'd like to go a bit further in that subject as well in terms of the different regions in Quebec, because we mainly transact in the Greater Montreal area, so Laval inclusively, the South Shore inclusively. And sometimes I know you have a few listings that go further away, and you've done some transaction that are further than Montreal, like Gatineau, even one in Kuujjuaq, for people that know where that is. What I want to talk about is what are the other regions in Quebec that are still good for investing, and you still might find the opportunities. We've seen the Sherbrooke on Estrie that's been very great over the last, I believe,
it was
5 years
boom
or so.
in the past 5 years, exactly.
Booming. I guess if you bought 5 or 6 years ago, almost everybody doubled their.
It's crazy. It was
value.
a crazy market, and Sherbrooke and Trois-Rivières, there is a strong rental demand, especially from the students and the industry that are developing in those areas. As you said, there was people doubled in the past 5 years, and when I was talking about price per units, that's where you see that values are doubled. 5 years ago, you were able to buy properties at 80,000 per unit.
Wow.
On average, 90,000 per unit on average, and today it's literally double of that. I think Quebec and Lévis, it's also a very interesting area because the economic growth and the industries, industrial projects that are there at the moment will bring workforce, and workforce need to be housed. So I think that's going to be a very interesting area to look at in the next few years. It's been already interesting in the past few years, but I think it's going to be continuing progressively grow in that matter. Also, as we've discussed, it's the North Shore of Montreal. Everything that you see, Laval, Blainville, Mirabel, the population growth in those areas. The
prices are catching up, honestly, right? They're catching up to Montreal, what I would believe is one of the cities where.
And what's also interesting is that in Laval, what's considered affordable. Montreal for affordability, it's $1,090 as per CMHC MLI Select program in affordability. In Laval, for the same unit, affordable would be considered $1,220.
$1,220 instead of $1,090 in Montreal.
Yeah. So affordable
Good
housing
is
more. You would do more money on affordable housing, even in Laval, than you would do in Montreal, because it's calculated on has to be 1/3 of the average revenue of a rental family, and so the affordability it's less in Montreal than it is in Laval.
FYI, we're talking here about one of the programs from the CMHC to finance a property where you're able to if you abide by the certain criteria that they want, like affordability, you're able to get better financing terms. I think for affordability, we're looking at 30%, 20% that you need, so you can have
40% of the units to be affordable to get 50 points in the affordable.
How much is it in new construction? Is this for existing, right?
Yeah, that's for existing. In a new construction with 10% of affordable units, you can get the same amount of points and qualify the property for better conditions, financing conditions, basically smaller debt coverage ratio, a better amortization period, and a ratio of financing on the economical value that would be, instead of 85, you can go up to 95 if you get to 100 points. So
for new construction, you only need 10% of the units to be affordable, and affordable in Laval is 12-20.
Yeah.
So that's why we're seeing a lot of construction there.
That's a good point you mentioned, because if you have a good team surrounding yourself, let's say whenever you're a developer, it's very important, I think, for a developer to also work with his mortgage broker even prior doing the project, because with those kind of analysis, don't even do the plans, because a mortgage broker could tell you, listen, if we put 5 studios on the ground floor, or 5 3.5s on the ground floor, you qualify. That's how much more we can get in financing, and explain you financially what could be done, instead of you doing the plans and then submit it to the city, get it approval, and then contact the mortgage broker and see, okay, how much can I get financing for that? Like, I've seen the synergy of mortgage brokers working with architects and developers, and consulting them on what could be a good thing to do, because you could have a 3.5 for 12.20, which is, I think, relatively standard market price today. It's not even, wouldn't even consider it affordable. It is considered by the CMHC, but at the same time, you wouldn't be losing so much money, and you would have access to the program. So
12.20 we're talking here, for in this scenario for a brand new unit, right?
Yeah.
So it's definitely very interesting for as much for tenants and for builders that they're able to qualify. These programs from the CMHC, we're talking here, MLI Selects have been very good for the investors over the last years. We've seen, how much would say 90%. Maybe not MLI Select, but insured loans with CMHC for sure.
Yeah.
Maybe the further we go back, the more we're seeing more MLI Select as well. They've been changing their criteria over the years. I think we've seen them change once or twice since the program was up. Those programs really are used by almost all investors, because they're able to create so much value in a market that changes a lot. Now, of course, everybody's happy with the interest rates going down, but when they were still pretty high, without that, I think we would not have seen the market going.
Yeah, I think it's actually the MLI Select program saved the real estate market in 2023, back in 2023, where interest rates were starting to skyrocket. We were asking ourselves how people could afford to buy properties in that moment, and then the MLI Select program came out, and we saw that as the Messiah coming, right? We're like, okay, that's one way of making it happen. And since then, as you said, 90% of our transactions in multifamily have been done through that program from CMHC. In the beginning of that program, we could get 100 points with energy efficiency only. Then it's been modified and changed. With energy efficiency, we can get only 50 points. But anyways, there's many details. I don't want to get too deep into the MLI Select program, but it's definitely been a strong help for the market in the past few years. So now that we know that the market in 2025 been very strong, because at PMML we have a lot of data which is our strong force, and what differentiates us from the rest of the market is that we do everything in-house. We have mortgage brokers, real estate brokers, insurance brokers, we gather a lot of data from the market daily, updating it also daily, keeping it on in our database that's prior to us. And we also implemented now AI into the database, right? Because we all know AI is as good as the data you feed it with, right? You could have the greatest AI, but if you plug it into fake statistics, it's going to give you out fake numbers. So it's important for us to have every property we analyze, every property we finance, every property we sell or buy, or on the insurance perspective. So the data we have is precise and it's real. It's on real time what's going on in the market. And many times we see stuff happening on the market and we read about it in the newspaper 6 months later. So we want to give you a little heads up of what's going on right now in the market before you even going to be reading it about in the newspapers in 6 months. What's happening right now that we're probably going to see in the newspapers in the near future in 2026?
Well, we're seeing a lot of transactions right now. So the way we're able to tell a bit, let's say in advance, is because you know we're keeping track of all the data here, and since we're pretty big brokerage firm, mainly acting in the multifamily asset class. We know how many accepted promise to purchase we have going on currently, and those are the transactions are going to be going to the notary in a few months, in 3 to 6 months, especially with those current financing delays that we're seeing right now.
So you have an idea what's going to be the average cap rate in 6 months?
Exactly, and we know the volume of transactions as well. For sure, some of those transactions are maybe not gonna through the notary as it always happens, but we're able to have a pretty clear idea, and the statistic is gonna come once all those sales are notarized, right? But we're able to tell. So I know on my end, what I've been seeing is the fall has been very good. A lot of properties being sold.
That's very interesting. You talk about that. So that means that if we go, whatever happening right now, like if somebody calls you today and says, what's the average cap rate selling for a stabilized property? And if you shoot him a cap rate, let's say 4.5, that doesn't mean it was necessarily today's cap rate. That was a cap rate that's in a transaction probably in the past 6 months. So 6 months ago it was 4.5. Now we have to adjust. If it was sold today at 4.5 cap rate, it doesn't mean that today 100%. It's a 4.5 cap rate. It's been like that 6 months ago. And 6 months ago interest rates were such, and today they're such. So we have to adjust. And that's, I think, the hardest challenge we have as real estate brokers is to make investors understand that if this property had been sold today and you want to take it as a comparable, it was the promise to purchase been accepted in a totally different market, right?
But they don't realize that. They don't realize that.
How would you explain that to a real estate owner who is looking at a comparable and his neighbor that's sold at such cap rates, such price per unit, and has similar revenues, expenses, and thinks that it should be worth the same thing? We remember that in the past 5 years we had spikes of price points increasing when the interest rates are falling, and vice versa when interest rates are increasing, the price has been stabilizing a little bit lower, right? How would you explain that? Like, it's always been a challenge for me to bring it on the table in a raw, like, you shouldn't.
Well, it's pretty. I mean, it's pretty easy to explain to them. Is it easy for them to understand it? Maybe not. They do have some emotional attachment sometimes to the price they want to sell their property at. So this we don't always have control over this. But what I will tell them is always that there's one thing that doesn't change about real estate, and it's always changing. The market is always changing, always new metrics. We're following the macroeconomic politics as well.
I love that quote. I think it should be a reel. We should cut it and make it a reel.
Good idea.
Something that never changes about real estate is that it's always changing.
But it is true. You're seeing the financing metrics changing. CMHC is gonna have new laws. Interest rates go up and down. We even have, we PML, we provide those notifications that you can get the
CMB daily.
CMB every day. We're both subscribed. We invite clients to go and subscribe as well. You're able to subscribe on the PMML's website, and
Can you explain what's the CMB, the Canadian mortgage bond?
Yeah, the Canadian mortgage bonds basically is going to be the rate from the government, and then each bank, they're trying to, the difference between this and the interest rate you're going to be able to have on your financing is their own spread, which is going to be basically their profit they're looking to make. So when you get the notification, it's I think yesterday it was 2.88, 2.8%. So the depending on the amount of the financing, they're gonna be looking at to have about 100 points more or less as a spread, and this is gonna be their profit, and that's what a mortgage broker is able to negotiate for you. So us, we know how to do the calculations depending on what's the amount of financing, because the bigger the financing, the less profit they're willing to take. So you're gonna have a lower spread, but they're definitely always gonna have a spread because they need their profit. I think that answers the question for you.
Yeah, definitely. It's and I want to keep hearing you about what's going to happen in the next few months, in your opinion, with all the transactions that are happening right now. And you said there's a lot of things that are impacting the values. Everything is changing in real estate as of interest rates, regulations, and different CMHC in different instances. But also macroeconomy has been very important lately for us. We've seen as well what's going on with our friends from the South, the United States, and the tariffs, how it's impacting our economy. We have more people losing their jobs. The buying power is going to be decreasing. So it's a very important aspect and to consider into real estate as well.
It's not been completely bad, by the way, as well. I'd like to mention I've had a lot of clients who operate their own businesses, and they've seen their local our local business going up. Some markets, there was me always transacting with other countries, now are sourcing from local markets, which is pretty good. One of my clients operates a textile company, but specialized textile, the ones for like firemen's, military, fireproof textile. And he told me he's having the best years since the tariffs have been going up, because all the businesses that was losing. He used to be losing his clients to companies in the States or in other countries, but now since the tariffs, it makes more sense for them to buy from a local company. So it's been good as well for some businesses, but it's always relative.
Interesting. And what do you think is going to happen in the next few months with everything that's going on right now? Because we spoke a little bit about the past, about the present, and if we know what's going on in the present in terms of how many offers we have accepted, at what price points, what cap rates, what price per unit, what do you think is going to happen in the next 6 months or a year? Do you think prices will be increasing in multi-residential real estate?
Prices will be increasing, yes, for sure. We're seeing a lot of properties having accepted permits to purchase and even having bidding wars currently. So that the comparables are going to be used and looked at in the next months and years. Is going to be with properties that went up in value. We both sold a few properties recently that had bidding wars, and even they were selling. They were sold over asking price in some scenarios. So you're seeing a good spike in the value of properties. We've talked already about why that is, the different factors like the interest rates, and then if we're talking a bit more long term, let's say to like the next year, I do believe that the interest rates are going to continue to go down. We just recently had another what's it called? Another drop of the interest rates down to what are we now? 2%, 2.25, I believe.
2.5, yeah.
Yeah, 2.5.
So for that, for the future, I have a little blitz of questions for you because I want to know. I want to hear from you basically the 3 common mistakes that's going to devalue a multifamily property, because our goal is to sell as higher as possible, as more expensive as possible for a property. And if somebody's planning to sell in the near future, in a year or 2 or 3, what are the 3 common mistakes that will decrease the value of the property that he wants to make sure that he doesn't make them, basically?
Yeah, sadly, we see this pretty often, especially for the property owners who are not, full-time investors, and they sometimes they have their own businesses or their own jobs, and they just do that, let's say, on the side, or it's properties that they got from their parents and whatnot. But I would start with poor rent management. They every year you're gonna see the TAL, Tribunal Administratif du Logement, submit their minimal augmentation for the year. You're even able to go up above the amount that they tell you, that the minimal amount, because if you do all your calculations, you can calculate what all the expenses have been going up for you, and you able to make the tenant absorb a bit of that. So what I mean is, a lot of the property owners, they've been not raising the rents to the minimal amount that
it's very important, because it's compound interest, right? You increase the first year 4%, and then the total you increase the next year about 4 or 5%, and so on and so on. So it's a blitz. I want to keep it short. So three common mistakes that devalue the multifamily property. You said poor rent management. Give me 2 others.
I'd say underestimating preventive maintenance. This can look like it's going to save you money in the short term, but it's definitely going to cost you way more in the long term. Then I would say poor tenant selection as well. You need to do those background checks. It's very important, those credit checks. We heard a lot of horror stories that you're stuck with a bad tenant. You can regret it for a long time.
Yeah, because a building's value depends on its ability to generate stable income, right? So good management and good tenants, good location, that's going to be your key points for that. My second question to you, and how would you calculate the true profitability of a property in 2025? What are the main criteria that would be looked and should be looked at?
Well, if you're going to do those few calculations in your analysis, you're definitely going to be looking at the cap rate that we talked about already, the IRR, which is the internal rate of return. This is good to account for the value growth of the property with the refinancing and capital outflows. Then you're also going to have the risk-adjusted return, to measure the profitability after accounting for the rate and vacancy variations. That has to be computed in for sure.
Yeah, and at PMML, you can contact a mortgage broker whenever you're analyzing a property. You look at the numbers. If you have a hard time understanding what the internal rate of return is, which is, I think, a very important thing to look at, mortgage broker could definitely help you with that and do the calculation with you, explaining you more in depth what it is. As real estate brokers, we also able to help you on that. Probably will be less precise than a mortgage broker is. My third question for you, Yacine, is why cash flow is no longer the only performance indicator? I know back in the days everybody was looking at what's the cash flow? What's the cash flow? Why is it not the most important performance indicator today in 2025?
Well, the investors are getting back their senses and understanding that it's a long-term game. So the cash flow is good, and it's always been good, but the other main indicator that's performance indicator is definitely going to be the long-term value creation of a property. Whatever optimizations you're able to do, physical optimizations as well, to create value and on the property. And there's well, what we've been seeing is that they're calculating now, what's going to be their takeout. Because I'm going to put this amount of cash down into the property. I know that money is going to be locked into that deal for a while, but how long? And how long is it going to take for me to take all my initial investment out, so I can and you're doing that by refinancing, but so I can go back and invest more in other properties and use that leverage, right? This is also one of the main
yeah, like you said,
interesting stuff in investing into real estate.
In cash flow wise, if we take the example, if we go back to, we discussed about Sherbrooke, how it's been doing great in the past years. If you bought a property in 2019 in Sherbrooke, and let's say a sixplex, and your 6 tenants are staying until 2025, in terms of cash flow, it doesn't change a lot because you did your increases what was allowed, but the property itself grow in value because you bought it at 80,000 per unit and now it's worth 160,000 per unit. Your cash flow haven't changed, but the value of the property, if you have to sell it today, you probably are doing 10% yearly return only on the growth of value of the property, which is really interesting. And that's why cash flow is not the only and most important thing to look at, how it used to be back in the days, because the property value and financing and many other things that are very important to consider as well. My fourth question to you is something we already discussed during the podcast today, but I want to give it to rephrase it differently. Basically, what are the regions, in your opinion, to watch in Quebec for 2025?
A bit like I think I'm going to go back on some of the regions that you spoke earlier that there's been good markets in those regions, and I think it will continue to go like that. But we can start with Quebec City and Lévis, economic growth, and I think you talked about it already. But those new industrial projects are going on there. I think it's still a good place to look at. Sherbrooke and Trois-Rivières. The demand for rentals, with a lot of universities there, a lot of students, so the strong rental demand has been very good for those sectors. We could add, North Shore of Montreal, Laval, Mirabel, Blainville. Still, population is still growing over there, and we've had proof of how good it's been doing over the last, probably few decades, right? I remember even since. People have been moving on the North Shore since we were very young, so it's still going on. And a lot of new construction, so it's not stopping. And maybe to finish, I think we haven't talked about them, but Saguenay, Drummondville, as last regions is it's those secondary markets have solid cap rates. We know we have a few brokers we have an office over there. We have a few brokers who operate over there, and it's very good markets. Not just multi-res, right? As well.
Everything,
for,
everything. Very interesting cap rates and all type of assets. And I think a little tip to whoever is watching or listening, I would monitor the interregional migration data. Where people are moving to. There's going to be different companies moving into certain areas. Let's say if there's a big warehouse opening somewhere or a big factory, and where immigration is going, because we've seen in the past years that immigration been only coming to Montreal. We see less and less. Montreal is less affordable, so we see a lot of new immigrants that are coming, and Montreal is not their first stop, like it used to be for many, many immigrants. They go some places like Drummondville, Joliette, where it was very rare to see immigration, but we see that they go more there. It's still more affordable. a very good quality of life. They have all the services required. So I
They
would
want to be
follow
near universities as well.
exactly. So I would follow where immigration is going and migration as well. So internally
point.
from the province, where people are going, that's a good point to me to understand where the markets will be booming, because that's where housing will be required. So I have another question for you. You mentioned that having good tenants is very important for an owner. What's the winning strategies to keep good tenants? Let's say you have already good tenants, but in today's market you want to keep them, right? What would be good strategies to keep good tenants?
It's a good question. So, being proactive and respectful with communication whenever they have some issues with their units. This is going to help have a good relationship with them, so they feel like everybody's having a good time there. There's not for sure you need to keep it to a certain level of professional, I'm going to say, but still be in a at least pleasant. It's a bit like a client and client relationship going on there. So then be fast and transparent with the maintenance. I would say have a good balance of rent increase with tenant satisfaction. So if you have tenants are very satisfied because you've been doing all the maintenance that's needed, being proactive about it, do it fast when they need to, and sometimes I guess you're able to give them a better augmentation, and they understand it more when you send them that new renewal, and with those calculations as well, you have to be very transparent about it.
Yeah, it definitely works when you explain why you're increasing by $50, right?
Yeah, it won't look gritty. You should hit, hey, these expenses have been going up, these expenses have been going up, these expenses have been going up.
Very important.
I cannot all absorb it myself. Here's I've done the calculations, here's the fair share that you will have to absorb, and if they've been satisfied with all the rest, they'll take it way better, and they'll want to stay there longer, right? Except if they have those, they need to move for X, Y, Z. But this is a good way to keep
in a market with rising vacancy rates, if you want to have a stable tenant, you would have less vacancy and a better property perception overall. So indeed, very, very important. And people who are building portfolios right now, buying multiple properties, it was very common to think, and it still is, that having all your properties in the same area is a good thing. It's easier to manage because it's a one-stop. Basically, you manage all the properties in the same area. You deal with one city or whatsoever. But I think market has tendency to change, and there's a lot of things that are changing, and definitely a very dynamic market. How would you be building a sustainable multifamily portfolio nowadays?
Well, I would see it a bit like a stock portfolio, in terms that you do need the diversification. You can't, in terms of regions where you have your properties. Of course, it's better to also have them near one another when you're gonna have a lot. A few here, then a few in this city, then a few in this city, and a bit different markets, but that are still growth markets. For another diversification is the types of units you're gonna have in those buildings. This is what we're seeing right now. When you're not gonna be, you're not gonna have all your eggs in one basket, in terms that if those units that rent above 1,500 that, like we talked about, are having issues being leased, you're seeing people not be able to afford it anymore, and then you're not gonna have your whole portfolio with those bigger units having issues. It's gonna be more diverse. The risk is better absorbed. So that's why I've been seeing clients, they're looking to buy those buildings with some studios, with some 3.5s, everything that fits under you're able to lease under 1,500 per month, and then let's say be proactive with the financing as well. Management, with property you can see, refinance, have different strategies in terms of that as well. So
yeah, I think it's the key point. You mentioned that being proactive with financing management, it's I think is the key point, because reinvesting the equity you have in order to be able to grow, beside the geographical diversification, it's definitely the key point. Thank you, Yacine. I think it's wrapping up our podcast today, and it was very interesting. Thanks to the data we have at PMML, we have real-time sales comparables, we have cap rate yields analysis by sector, regional, economic projections. So all of those...
And a lot of conversations.
And a lot of conversation, yeah.
With colleagues.
Because thanks to the PMML data, we turn intuition into a measurable decision making, right? It's not just a gut feeling, it's statistic, it's numbers, which we know numbers don't lie. And we thank everybody who've been with us for that podcast, and hoping to see you next time. Thank you.